Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market update. Hope everybody is doing well today. So in today's markets, guys, very red day coming off the back of another negative CPI report, this time coming from producers. This is now pretty much the fifth inflation report in a row over the past month and a half that has been hotter than expected. And finally today, potentially breaking the straw that breaks the camel's back. The market's finally reacting to the fact that bad news is potentially indeed bad news, as it just sends the Federal Reserve the message that they may not need to cut rates as fast as anticipated, and even potentially not do as many rate cuts as anticipated earlier on in the year for the remainder of the year. Keep in mind, we were predicting in December at the last summary of economic projections that the Fed released in December, also known as the dot plot, Federal Reserve members were potentially pricing in 5 or more rate cuts over the course of the year. Now we're pretty much down to about 2 or 3. So that's been cut in half. And with this most recent inflation data, not only today, but CPI we had on Tuesday and all the ones in the prior past month and a half and a bit, guys, it's just not sending the right message to the Federal Reserve that they're in any rush to cut interest rates. Very important meeting with Jerome Powell next Wednesday, where he will make that determination of whether or not the Fed sees any urgency in decreasing interest rates. So in today's video, guys, we're going to go over that PPI report that came out on the morning. We're also going to be going over exactly what I did with my portfolio. The thumbnail is definitely not clickbait, guys. I did sell most of my holdings in the trading portfolio. That being said, I also have 2 long-term no-touch portfolios, my stock portfolio that I never touch, pretty much only long, and also have a crypto portfolio that I did not touch. Those 2 portfolios still intact, but my trading portfolio that I use to fund my living expenses pretty much, that I have to be a little bit more careful in terms of the risk management that I make surrounding big decision days like next Wednesday with the Fed, and I just did not want to take the risk, and I will explain why in today's video. Now, we also have one earnings report that we're going to cover today. It was Adobe coming in with earnings after the close. Tomorrow, we will do most likely Dollar General and Ulta Beauty, but I want to focus on my trading decision today and the Adobe earnings as a whole. Hopefully provide you guys some insight into why I made the decision that I did today. And obviously after that, we're going to cover our major technical analysis on indexes and as a whole, guys, our major tech names as well. And lastly, conclude with a review of my portfolio. So without further ado, guys, let's get right into today's video. So SPY down 0.2%, QQQ down 0.25%. And if you take a look at the heat map, guys, it was definitely not the best day at all. Now, we did have a little bit of outperformance in some of our big tech names, Microsoft, Apple, Google, and Amazon. But for the most part, other than energy, guys, big red day across the board as a whole. And you can see that best when we pull up the one-day relative performance. Only communication services, which is led pretty much by Google, only communication services and energy were green. Everything else really going through the washing machine, especially your interest rate sensitive plays such as real estate, consumer defensives, financials, heavily exposed to interest rates, and interest rates yields, guys, today having one of their largest percentage increases in over a month at this point, which just goes to show you the market is potentially finally reacting to the fact that inflation is a little bit sticky, and we are potentially going to keep rates a little bit higher than expected for a little bit longer than expected. Now, keep in mind, guys, that the overall trend of inflation is obviously good, but we're still not at the target, and the Fed really wants their 2% target, right? So let's take a look, guys, at the producer inflation data that came out today, and you're going to see why it was very important. So take a look at this. Wholesale inflation rose 0.6% in February on an annualized basis, guys. That is like over 7%. Not good. In February, much more than expected. Actually, twice what was expected. We were expected for 0.3 month over month. We got 0.6. So producer price index, which measures pipeline costs for raw, intermediate, and finished goods, jumped 0.6% on the month, double the Dow Jones estimate. On a year-over-year basis, the headline index increased 1.6%, the biggest move since September 2023. 2/3 of the rise in headline PPI came from a 1.2% surge in goods prices. We'll take a look at that shortly. And the biggest increase since August 2023. That's a significant amount of time, guys. 6 months, thanks to a 4.4% jump in energy. Retail sales increased 0.6%, less than expected, while weekly job claims filings nudged lower to 209,000. So let's take a look in why this matters for your producer price inflation metrics. And you'll see, guys, that the increases were substantial. So here's your 1 month percent change. That we're going to see right here. So here's your massive increase for the month of February. Take a look at where we were in January. January was only 0.3, which is relatively in line with the most you would get prior to the pandemic, right? But the 0.6 read, guys, is fairly rich. You can see last time we got that pretty much is July and August of last year. Fairly hefty increase if you ask me. In terms of your goods boost on a month over month, look at the goods, guys, on a month over month basis, 1.2%. That is getting as high as pretty much 2022, well above the peaks of prior to the pandemic. And services as well, services remaining fairly sticky here. We did get a slight little read down on the month of February, only to 0.3, but still slightly in the elevated top of the range of the prior to the pandemic, right? Now let's take a look on a 12-month basis and see, put these numbers in a little bit of perspective, right? So here is your total producer price inflation number. So you can see that it's about 1.6%, which is relatively low compared to prior to the pandemic, right? That is below the Fed's 2% target for consumers and also for producers. So we're still good, guys. The trend of inflation is good, but we did have a slight little hot month here in producers for the month of February. Take a look at your goods number. Goods as a whole are still relatively low. The problem came that last month we were actually in a deflationary read of about 1.5% to the downside. And now we're back to positive with 0.3. Now, in the grand scheme of things, 0.3 is not that bad when we look back to before the pandemic, right? In terms of services, services have also come down so much since 2022. We're now back in line with some of the peaks that we had prior to the pandemic as well. But you did have a net little increase here, January to February, 2.2, 2.3% from a low of December of sub 2%. So services as well, still being maintained fairly sticky at the 2.3% read. Now, so that is pretty much everything for your producer price inflation. So as you saw, guys, on the month over month, right? If you take a look at the month over month, it looks worse on a month over month basis as it does on a yearly basis. However, the numbers, guys, they're just coming in hotter than expected. And as I've said, this is about the 5th inflation report in a row where analysts have a certain estimate and we come in either marginally above or in this case, well above expectations. So it's just not good as a whole, guys. The trend of inflation as a whole, that is good. But the fact that we remain sticky in the levels since pretty much last fall here is proving to be problematic if your narrative is for multiple rate cuts over the course of this year, like 4 or 5 rate cuts. I don't think we're going to get that at this point, guys. And if you're expecting rate cuts as soon as May or June, it's very possible that the Federal Reserve just says no to that and instead starts doing them in either July or August, which really pushes back rate expectations quite a bit from where they were in December. In December, a lot of people thought that for sure March or May was going to be your first rate decrease. And now we're pushing that, a further 4 or 5 months down the road. So that is just not good in terms of inflation numbers. As a whole, guys, it wasn't that bad of a read when you take a look at the bigger picture at play here. But in terms of the Federal Reserve's narrative to decrease interest rates, it definitely does not help, and neither do the past 5 reports that have come out over the months of January and February. So just please keep that in mind. Now, before we get into earnings, guys, I just want to do a quick little rundown as to what we're looking at because of the high inflation that we've been getting recently, guys. The reason why I sold. So we're going to tackle that first, but obviously we're going to do my portfolio at the end of the video just to show you guys where I stand right now. But here are just a few of the things that stick out to me, guys, right? A few little red flags here and there, which could potentially lead into next Wednesday being a complete rug pull by the Fed. If Jerome Powell is very hawkish with us and really drives it home, you guys know that for the past 3-4 months, it's been a cat and mouse game between Wall Street and the Fed, right? Wall Street has been trying to consistently call the Federal Reserve's bluff, saying, when the Fed says higher for longer and we don't have any immediate need to drop interest rates, Wall Street keeps calling their bluff and says, Well, no, you guys are actually going to cut probably 4 or 5 times this year, and it's going to be on this date. And so far, Wall Street has been disappointed, but has not really faced the music for that disappointment. As you can see, the markets have just plowed up January, February, and even through March, completely disregarding the Federal Reserve statements. But I do believe, guys, that this March meeting, because of the fact that they release another dot plot, another summary of economic projections, I do believe this is going to be the one that really deflates Wall Street's expectations and really has analysts having to taper back on the amount and the date at which time the Federal Reserve is going to bring back interest rates. So here are just a few of the red flags that jump out to me, guys. In terms of the macro, we don't have any more earnings that are going to be notable for us. So a lot of the lift that was provided in big tech here over the past month and a half has been due to a lot of big tech earnings. You guys know a lot of the outperformers on the earnings cycle, Amazon, Meta, right? NVIDIA, of course. There's just no more company earnings. And as a whole, earnings season has wrapped up. So we won't be able to get any external catalysts that are going to pump the markets that much until next earnings cycle, which is roughly in a month's time. Number 2, for the macro, we've had bad inflation data for 2 months now. That's what we were previously talking about from when we were covering the PPI report, right? Just not good. Bad inflation data for 2 months. I'll bring up the CPI again, guys, and you can see the CPI has just been sticky right around your 3% mark, refusing to drop lower. And, you know, services is where most of your inflation is, most notably in shelter. And even though that's been coming down, it is still way too sticky for the Federal Reserve to feel any immediate need to decline, to drop interest rates, right? So bad inflation data could be plaguing us. Now, we also have seasonality. I've talked about this for a number of weeks at this point, probably about a month and a half at this point, how February and March are known to be negative months. We just haven't really seen much of that drop at all. Markets tend to be bullish the rest of the year, but I have a very hard time believing, guys, that we are going to get no drop whatsoever for February, March, April, and the markets are just going to keep going up every single month of the year. If we do have one point in time that I do believe we drop off for some healthy and healthy monthly consolidation, it will be after the Federal Reserve statement next Wednesday for the month of March and potentially early April. May, June, July are known to be very decent months, usually in terms of seasonality. That's where I expect the bull run to continue. But for now, it's been a very beautiful 4 months. I just personally think that it's going to be a little bit of a breather for the markets coming up soon. Now, in terms of number 4, Powell pushes cuts further out and fewer. So that is what we're going to look at next Wednesday. That could be the day where Jerome Powell finally really drops the hammer when he's answering reporter questions, when he really says, listen, we've told you guys before, we're not willing to cut interest rates right away. The committee has still not made a decision. We still need more data. And I want to tell you guys that most likely now at this point, May is probably off the table and we may be looking at June, July, or even August and fewer rate cuts. They've mentioned a few times in the past, over the past 2 weeks, guys, several Fed members have said they wouldn't be opposed to decreasing interest rates, let's say once in July, and then pausing and just waiting for more data, right? So that could be a problem as well. A lot of people are expecting back-to-back cuts at every single meeting after June or July. May not play out like that. So that's going to be on the watch for the macro. In terms of the specifics, in terms of your technical specifics, well, all assets, guys, are relatively greedy right now. Stocks have been greedy now for pretty much the past month, right? Extreme greed to greed levels that we know on the channel. In terms of crypto as well, here's your crypto fear and greed index. You guys know it's been extreme greed for a while now, all the way stemming pretty much for the past 2 months. So a lot of greed in your markets right now. You guys have seen that, right? Semiconductors, NVIDIA, SMCI. A lot of semiconductor names have been fairly greedy right now, and I do believe that if some of those greedy assets have a bit of an extended sell-off, you will start getting headlines all over the place. Is the AI bubble finished? Is NVIDIA finished? Is the crypto rally finished? Obviously, we know it's not. Obviously, no, 2024 and 2025 are going to be good years as a whole, but it's going to fuel a sell-off narrative if ever it happens. So keep a watch on that. Now, number 2, in terms of the specifics, all major sectors at the low of the day currently today. This is a big one, guys. I talk about rotation on the channel a lot because it does matter, guys. And why I always keep a focus on QQQ, XLF, and XLV, because they're your bigger segments of the market. These three pretty much set the tone for the day. And it's been a very, very long time. I'm talking probably about 2.5 months at this point since I've seen a single day where all of your major sectors are hitting the lows at the same time. Take a look at your QQQ. Over the course of the day, right? QQQ smashing the lows right at the open, smashing the lows for a better part of the day. XLF, the same, smashing the lows first thing at the open, dropping at the same time. XLV Healthcare, smashing the lows first thing out of the open and dropping at the same time. Usually, if you guys remember all of my previous videos, if we've had a big sell-off in tech, it's usually been balanced with either flat or slightly tiny declines in financials or healthcare, or the opposite, right? When QQQ outperforms, you say a slight pullback in either financials or healthcare. It keeps the market rotation healthy. When I see all three sectors dropping at the same time in one given day, a little red flag goes off in my mind because that means that money is actually exiting the market rather than rotating. Now, we did have a little bit of rotation into some big tech names here, but keep in mind, these are some of the big tech names, guys, with the more favorable valuations. A lot of your semiconductor plays on the course of the day were netly down. So that's just another red flag that jumps up to me, guys. It doesn't happen that often, but when it does, it has to be notable to you. And when it starts happening more and more often over the span of a week or two, that is when you're going to get an extended sell-off to the downside as money just gets repriced and traders are done pretty much buying all these dips. They would rather wait and buy later dips. Now, number 3, very important as well. SPX and XLF are in a rising wedge. So obviously you guys know that we're in a beautiful uptrending channel. And I still reiterate, yes, the bulls are for now still in complete control. Beautiful trend line on SPY, beautiful trend line on QQQ as well. However, take a look at your futures, right? S&P futures paint a better picture because we get the overnight sessions as well. Take a look at this rising wedge that's been manifesting ever since pretty much the early part of the month of January. Now, I was expecting maybe this week with the CPI data, we may get a break of this and send it to the upside. However, these rising wedge patterns, guys, this is a bearish pattern. Usually if you get a break of the wedge to the downside, you are almost guaranteed a rollover into lower lows. That's not the only one that's presenting a rising wedge opportunity over the course of the past couple of months. Take a look at financials as well. Financials as well, yes, they've been moving to the upside, but we're coming up on big all-time high resistance into a rising wedge formation. If we lose this rising wedge, you could get some extended weekly sell-offs to the downside in financials, and that would play off into the narrative of yields coming up and being a bit higher for longer. So that's just another little bit of a red flag that I'm seeing in some of your major indexes. Now, big tech earnings winners have a lack of follow through. This is something that I've touched upon briefly on the channel, and it's just something I noticed. It's not the most important factor, but take a look when we look at our big earnings winners, right, that really smashed it. Take a look at Amazon, right? So Amazon after earnings, we peaked at about 172, the following week about 174. We've kind of been stuck around those higher levels. Amazon just refusing to break above the 178. Can it happen over the next couple of weeks if ever I'm wrong? Yes, but it's been a noticeable lack of follow through, the bulls' unwillingness to push the higher levels in some of your earnings winners. This also happened on Meta as well. Meta had a tremendous day after their earnings, and you notice over the past month and a half, yes, they've came up slightly above their earnings, right, for a few days, 5% over, but for the most part, guys, we're still kind of trapped within this range. I'm not expecting every stock in the market, obviously, to be like NVIDIA and just do this and this and this, but when you notice a lack of follow through, guys, after breaking out to new all-time high levels, it's just noticeable to me that there may be an unwillingness by the bulls or a little bit of hesitancy by the bulls to push those levels higher without some potential extended sell-offs to the downside first that just reset prices, reset some of our weekly RSI levels lower to where it becomes better and better for those long-term bulls to be buying. So that's what I'm noticing. Microsoft as well has had this as well. Now, we did break up over the top today, but for the larger part, since their earnings, right, it's been relatively flat for an entire month except for today. So lack of follow-through on Microsoft as well, except for today. And even a company like Netflix, who really killed it, right? 13 million versus 8 million subscribers expected. Fantastic earnings. Now, yes, they have broken through a key level, 575. We are up pretty much, 6.5% from that time, but still you would expect to get a bit more follow through from a company like Netflix. But so far, they've kind of just been, it's been really struggling here, guys, at the higher end of the range, which also leads me to believe that the bulls are a little bit hesitant to gun for the all-time highs right away because people may be thinking about those higher interest rates for longer and how it could potentially bring some of these stocks a bit down to more affordable valuations for them to be buying the dips. Now, our before last point, a lack of weekly consolidation. I've been talking about this one for a while as well. Lack of weekly consolidation. Now, QQQ has been better than others. We have had a few periods of consolidation in the markets, and QQQ as a whole for the better part of the last month has been relatively flat, sitting around here around between the 435, 439 level, right? So QQQ, a little bit more consolidation than most, but still weekly overbought levels. We really have not had a 5-6% consolidation drop off as we've had last fall, but that's also because, we haven't really had really bad data, right? The data hasn't been the best, but it hasn't been fall off a cliff. Inflation is netly surging up again as it was last October, right? So I'm not expecting like a 10% correction, but still 5-6%. Financials just the same, right? There is no weekly consolidation at this point. In the past 4 months, guys, only a little bit of sideways consolidation before extended rally. And even healthcare, although they've been consolidating for the past 3 weeks, we're talking about consolidation to the downside, only about a 1.5% in relation to a almost 20% rally to the upside, right? So things are a little bit extended, and it leads me to be a little bit cautious, right? I'm cautiously optimistic. I'm not bearish on the markets, guys. Don't get me wrong. I don't want this video to sound too bearish. I just want to give some context as to why I'm feeling a little bit more cautious. I am still optimistic about 2024 and 2025. That has not changed. But in the short term, I'm very cautiously optimistic, meaning if ever we get dips, they will be very welcome and I'll be aggressively buying, but I have to be cautious and I have to manage the risk. Now, lastly, semiconductors hold the absolute key, all right? Companies like NVIDIA, right? NVIDIA finally potentially starting to curl over on the weekly, right? They've been struggling here in the past over the last couple of days. Companies like AMD as well have had significant sell-offs from their high, talking about almost 17%. And the semiconductors industry as a whole, guys, now potentially setting up the daily downtrend, maybe into weekly consolidation. We're significantly off the 12 EMA. So if semiconductors from the highs pull back, 15% just to go touch this to set the weekly higher low for further trend continuation, it will still be a few weeks worth of sell-off. And you guys know what happens, guys. If the semiconductor industry starts selling off aggressively for a week or 2 weeks, you know what the media is going to say. They're going to start saying overvalued. They're going to start saying AI bubble. We know it's not. We know semiconductors are here to stay, and 2025 and 2026 will be a beautiful ramp for them. But just to say, guys, overbought conditions leading into a little bit of a sell-off, those media headlines will definitely play a part in having people question their investments and whether we are trading a bit too rich on companies like NVIDIA, companies like AMD, companies like TSM, which have recently hit pretty much their all-time highs as well. Companies like SMCI, of course, which are relatively rich right now, and even companies like ARM, who have had significant rallies. If all of those start pulling back at the same time, expect the media to jump all over this and use it as an excuse for a bit further sell-off. So those are all of the reasons that I've been looking at this, guys. I know that currently 18,000 on NASDAQ futures is such an extreme support level. We haven't lost it yet, right? The bulls are still in complete control of the support level, complete control of your trend as well. But Wednesday, I just don't want to end up in a situation, guys, where I'm having to take this trade potentially hoping for a retest, right? If we flush and never retest the trend line, right? If we flush, retest here, and then just drop, and I'm waiting for this retest of this trend line, right? It may just not happen. I just don't want to be caught with my pants down. In other words, I would rather take profits here, reset to cash, have full buying power. That way, if ever Jerome Powell gives us the rug pull next week, I am ready. And if ever I'm wrong, guys, well, it's no problem at all. You guys know what that account is used for, right? We are just going to continue running the wheel strategy on some companies that remain at relatively low prices. Apple, Google, going to be targeting the solid companies. So really nothing changes, guys. If I'm right, well, I get a little bit of downside protection and I'm able to buy more dips. If ever I'm wrong for any which reason and we just continue ripping, well, it's just business as usual and I will reposition into my weekly put options that I tend to do. But until Wednesday, guys, I am going to stay very, very cautious and mostly stay out of the market until I hear what Jerome Powell has to say and what he makes of all the most recent inflation data. If he just brushes it off as if nothing happened, as he kind of did last Wednesday when he was testifying in front of Congress, if he just brushes everything off and we get a decent SEP dot plot report from the rest of Fed members, which indicates that they're also brushing off inflation and they do want to proceed with 5-6 rate cuts over the course of the year and they see June or July being the likely start, then fine, we'll continue to push higher. But if not, well, at least I am protected, guys. And I've been saying this for a considerable amount of time, about a month and a half at this point, where I've been saying, you know, guys, be wary, try to do some covered calls and stuff like that. Well, now I'm pretty much playing into my own thesis, my own narrative. So I hope that you guys understand the reasoning behind why I chose to make that decision. Hopefully the transparency is helpful for you all. I just want to reiterate, guys, that I'm just a little bit short-term cautious right now of what may transpire next week and how that may impact some weekly consolidation here. Right? I hope you understand that I'm short-term a little bit bearish here, but long-term still excessively bullish on these markets, right? We're looking to find the dips. Now I just want to wait for the market to come to me. So we'll take this one day at a time, as we usually do on the channel. Now, with all that being said out of the way, guys, sorry for spending a bit too long on that, but still a notable change, so I felt I had to bring it up. So with all that being said, guys, let's jump into ADOBE earnings over the course of the day. So ADOBE actually, after earnings, guys, down about 10%, 11% from the close. And I'm surprised about this one. They actually had very, very decent earnings. Take a look at this, guys. Double beat on EPS, and beat on revenue. This company did excessively well in their earnings. Now, the reason for the drop, a lot of people are saying, you know, a lot of news articles are saying weak Q2 guidance, but the guidance actually wasn't weak at all. They barely missed the guidance. I believe that this is fairly overdone in my opinion here, guys, in terms of the sell-off. Double beat. Now, few of the headlines, guys. $25 billion in buybacks was announced as of this most recent earnings call. That's about 10% of their float. That was the headline of today's earnings. Very, very good that they're buying back tremendous amount of stock. And you can see here, in terms of ADOBE, they've never really had a problem in buying back stock. This is their shares outstanding over the last 13 years. And you can see for the most part, guys, over the last 10, 15 years, they've been consistently buying back stock. So it's nice to see them throw another $25 billion in buybacks in the pipeline here for the next foreseeable future. The company also has a low amount of debt. So I love to see that. About $6.8 billion in cash, only $2.5 billion in debt. They've never really had a problem with debt. Let's pull up their debt right here. So you can see over the past 5 years, their debt, the red line, has always been significantly below their yearly free cash flow numbers, and they're building stockpile of cash, which is the dark blue column right here. This past quarter was relatively the same. Very good debt management. They also have very good free cash flow, which we saw on the previous chart. They have high net margins. ADOBE has never had a problem with net margins. Take a look at the last couple of years. They've actually been improving net margins from about 26 now all the way up to about 28%. And the last 5 quarters as well, about 26 to about 28, 29%. Very decent net margins. It makes sense. They're an entirely a software company, right? And they're able to just drive net margins to the bottom line because they don't have that many costs of goods sold. They obviously have a decent amount of operating expenses in terms of R&D and sales and marketing and stuff like that. But in terms of the cost of selling their product, it's really easy for them, guys. They run a subscription model, right? So it's very, very high margins. Now, they also have a decent amount of stock-based compensation for employees and management, about 8.7%. Anything under 10% for a tech-based company is usually pretty good, and these guys fall in line with that standard. Now, before we get into some of the valuation, let's go over some of the headlines. So ADOBE shares slipped 10% on soft sales forecast. You're going to see it wasn't really that soft, guys. Now, here's the headlines. ADOBE shares tumbled as much as 11% in extended trading on Thursday after the design software maker issued strong fiscal first quarter results in terms of their EPS and revenue that they beat, but came up slightly short on quarterly revenue guidance for this upcoming quarter. During the quarter, ADOBE also abandoned its $20 billion acquisition of design software startup Figma after the UK regulators found competitive concerns. This was a botched deal. Well, not really a botched deal. They were willing to acquire the company, but European and UK regulators said no in terms of it wouldn't be fair to the competition. So they had to go back on their $20 billion acquisition deal with Figma. And because they had to go back, the company paid Figma a $1 billion termination fee. And Adobe announced an early version of an artificial intelligence assistant for its Reader and Acrobat apps. So playing into the AI narrative, Adobe sees, here's the guidance, guys, right? Adobe sees fiscal second quarter earnings of $435 to $440 per share with $5.25 to $5.3 billion in revenue. Now, here's your expectation for guidance. The analysts polled had been looking for $438 a share, which is literally above the midpoint that they guided for. And what were analysts looking for as well? $5.31 billion in revenue. What did Adobe guide for? $5.25 to $5.3. So at the worst, they missed by what, right? Like $50 million approximately, which is literally 1% miss. And because they had a 1% miss on only the revenue guidance, the stock is down 11% in the after hours. Doesn't make sense in my opinion, guys, to be quite honest with you. That's why I say that the sell-off is relatively overdone. In terms of their financial highlights though, guys, it was a tremendous quarter by Adobe. Take a look here. Total revenue growth 11% year over year. Very good. 4.6 in Q1 of last year. Versus this 5.2 billion, very good. Look at this net increase in earnings per share as well. This company has never had a problem with growing EPS and growing revenue on a year-to-year basis. Take a look at EPS growth over the foreseeable future. Gorgeous curve, exactly what you want to see. Revenue, gorgeous expansion curve, exactly what you want to see as well. So that's not surprising there. Operating cash flows down ever so slightly. Now, the operating cash flows, they were slightly down because of that $1 billion payment that they had to pay to Figma because they had to terminate their acquisition deal. We'll look at that in the financial statements as well. If not, operating cash flows would actually have come in netly above at about 2.17 billion if you were to add back that 1 billion, right? Take a look at their lines of business. Digital media, which is pretty much their software suite of products, right? Take a look at this revenue right here in terms of their Adobe Documents division here, 18% year over year. Their creative tools as well, think of Photoshop and Adobe Premiere and the likes, right? 11% year over year. So their total digital media up 12% year over year. Very good. In terms of net new ARR, ARR is annual recurring revenue. Most of Adobe's revenue, actually about 98% of it, is in subscription recurring revenue on an annual basis. That was netly up. And your ending ARR was also very good, coming in at about 15.76 billion for the trailing 12 months, which is excessively good here, guys. Very, very good results by Adobe. Nothing bad to say here whatsoever. Extremely good number of annual recurring revenue subscriptions by their consumers. Very, very good. Their digital experience division also went up as well, 12% year over year. Remaining performance obligations. How many deals do they have currently in the pipeline? You can see here that currently they have about $17.5 billion of remaining performance obligations in the pipeline. And that's substantial, guys. Keep in mind, Adobe is a company that makes, roughly $20 billion a year. So for them to have roughly, $17.5 billion, that's about a year's worth of revenue that they still have in the pipeline. Very, very, very solid. And you can see here that they did repurchase 3.1 million shares over the course of the quarter, which at current share prices, guys, let's say 3.1 or let's say 3,100,000 here times their share price. Let's call it an average about $500, right? You'll see it's about 1.5 billion worth of share buybacks, and they just approved another 25 billion. So that's going to be excessively good as well. In terms of their financial statements, guys, really nothing bad to say about the company. Company just continues to deliver, right? Let me read some quotes by the CEO here that we didn't go over, but here's a quote by the CEO. Adobe drove record Q1 revenue, demonstrating strong momentum across Creative Cloud, Document Cloud, and Experience Cloud. We've done an incredible job harnessing the power of generative AI to deliver groundbreaking innovation across our product portfolio. Right, the Q1 results and record RPO, remaining performance obligations, money in the pipeline, reflect strong customer adoption of our innovative products and services, said the Executive Vice President and CFO. As a result, our strong trajectory of growth and profitability, we're announcing $25 billion in share repurchases. And the guidance for next year as well, guys, guidance for next year is going to be very good, about 10-11% in revenue growth and about 15% EPS growth. So nothing bad to say there at all. Their guidance is right here. They don't give percentages, which is why I just gave them to you verbally. But let's take a look at their financial statements, guys, and you'll see everything is excessively good here. Nothing bad to say whatsoever. So take a look, guys. Here is their total revenue. You can see total revenue, 5.1 billion. Look at their cost of goods sold, guys, because it's a software company. Literally nothing, like 10%. Their gross margins before operating expenses are like 90%, right? That's absolutely fantastic for this company. Where they have a bit more expenses is in your operating expenses. You can see there's a one-line item. That is your $1 billion for the termination fee of the deal with Figma. Other than that, guys, they would have come in, operating expenses would have been pretty much at 2.685 billion, right? So 2.685 divided by your 2.501, it's only growth of operating expenses by about 7.3%, and the revenue is up about 11-12%. So operating expenses really not growing as fast as revenue. Company having very good operating leverage, growing net margins to the bottom line. Take a look at their balance sheet as well. Nothing bad to see here either, right? 6.2 plus 566, let's call it about $6.8 billion in cash. And in terms of debt, right, their long-term liabilities, take a look, long-term debt, about 2.2 billion. With some operating leases and some income taxes payable, let's call it about $3 billion, right? So at least twice the amount of cash on hand than they have debt. So very, very good. Nothing bad to say about the company. And in terms of stock-based compensation for 3 months, you'll see it's about $451 million. As I said, it's about 8%, right? 8.7%. When you take the roughly $450 million and divide that by their total revenue of 5,182, it's about 8.7%. Really nothing bad to see here at all, guys. So in terms of the valuation of the company, valuation is not too bad, to be honest with you. Revenue growth through 2027, about 10% per year. EPS growth through 2027, 12.5% per year, which is fairly good. Their PE, given these numbers, their PE ratio at $510, which is roughly the share price right now, trading in the after hours, right? About 507, 5010. PE at the end of 2024 is about a 28.5. In relation to the company's history, that's actually not that bad. We'll take a look at that very, very shortly. In terms of their PEG for 2024, sorry, this should be 2024. So in terms of their 2024 PEG ratio at $510, it's about a 2.28. Not terrible, but not the best. Between 1 or 2 would be better, but 2.28 is not terrible, guys. Now, if we take their valuation at a constant PE multiple, now why I take 35 to 40 average. Now, this is just the most simple valuation metric that you could possibly use, using it as a constant PE ratio for the company using a trailing 12 months. Now, if you take a look at Adobe's PE ratio, this bottom section right here, you'll see that since pretty much 2016, right? They've had a trailing PE of between roughly, let's call it 40 and 50, usually on the higher end, right? But you can see that for the most part, except for a dip in 2022 when the market fell apart, right? For the most part, they trade between 40 and 50. So if I want to be conservative, if in 1 year I give them the same multiple, as you can see right here, if we take the forward PE, it's about 28.5. But in 1 year, if Wall Street allows this stock to continuously trade at its current multiples, which are right now about a 48.5, so if 1 year they continue to pump this up and give it a roughly 48 PE ratio, or let's say I took a more conservative estimate here of between 35 to 40. I'm not even taking 45. I'm not even taking 50. If we do that, right, which has been the case for Adobe over the past, let's call it, 6-7 years at this point, right? So we just take their earnings per share amount in roughly, 2024 at this point. So just going to show you guys how I do the calculation. You take their 2024 EPS, about 18. Let's call it about 18. And then you do 35 times 18 or 40 times 18. That is your price to earnings ratio, right? And it gives them a price target of about 630 to roughly 715. Now that's being relatively conservative. 630 is roughly your prior all-time highs, prior 52-week highs rather. And 730 would put them right above, slightly above, maybe 5% above their previous all-time highs. So it's really not that much of a stretch for Adobe. And in terms of analysts would tend to agree with that as well. You can see the midpoint of their price targets, and they use far more complex tools to do discounted cash flow analysis and stuff like that, right? So their modeling is more complex than mine, but you can see they end up with roughly the same price targets, right? Roughly between 650 and 750. Mine are not too far off, 630 to 715. Just goes to show you guys that the company does still have some decent upside, especially from the roughly 500 level that we're currently trading at. So I would not be opposed to buying some Adobe shares down here. If you're a long-term believer in the company, you do have some fairly decent upside for the future, if the market allows it to trade at the high multiples that it has had in the past. Obviously, if the market has second thoughts and doesn't allow it to trade at that, well, then we have to bring this down quite a lot, right? If we were to trade at roughly 28.5, well, then your stock is fully valued at what it is right now, right? It only can go to these prices if the market lets the multiple trade at higher levels. So just keep that in mind. But I like Adobe. No red flags with the company whatsoever. It was a decent earnings for the most part. Nothing bad to say about the company, guys. So now that those earnings are out of the way, guys, let's take a brief look into our technical analysis for our major indexes, shall we? So for our major indexes, guys, SPY still in a daily uptrend. Despite today's sell-off, we are still holding the 12 EMA, right? And we are still in a daily uptrend. The level to watch is still, in my opinion, 508.86. Let's just call it 509. If you flush that low, you will end up with a daily downtrend. And we will be looking at the downside of the trend line to play as support, 505.50 level. That being said, the bulls are still in control here of your SPY, but just keep in mind, guys, that on the futures chart, which does show a bit more trading, right, in terms of hourly and 4-hour breakdowns and everything, we are in a little bit of a rising wedge within the context of a healthy uptrend, right? So I am getting a little bit nervous right here. If we do see a breakdown here from our rising wedge right here, I do think that that will translate into potential loss of your general trend line here. So I'm being very cautious, and that in my mind is only going to happen as of next Wednesday. So keep a very close eye out for that. QQQ, nothing to say as well. Your bulls are still in absolute complete control. And as I highlighted on the NASDAQ 100 futures chart, guys, this 18,000 level, extremely solid support. And we still haven't broken it. Even with today's sell-off, you can see how hard it is for the bears to close daily candles. Look at all these attempts to close daily candles below the levels since we've been over it. They have not been able to do it now 4 or 5 times in a row. Previous big resistance, previous big support. That being said, if we do lose this level, it's significant not only because we lose a big support level at 18K, but because your trend line is so close. And you see that on QQQ as well, right? This is pretty much the exact same level, right? If you look at it on the QQQs, the level we're playing with right now is about 439, right? If you lose 439 and close below it at this point, right? Let's call it about 439 all the way down to about 435. If we lose this level right here, guys, extremely pivotal level. Your higher low is right here, 436 roughly. Lose 436, you end up in a daily downtrend, potentially end up losing this big support level, right? Previous resistance, now support, and you could potentially also lose your trend line. That trifecta of things, in my opinion, could lead to some extended weekly consolidation, but the bulls are in full control. First weekly level stop is about 423, and then it's all the way down here, guys, at about 405. Now, I would be surprised if we come down to 405, but I wouldn't be opposed to seeing a net sell-off about 5-6% in your indexes. That would bring us down to roughly the prior 420 levels if we indeed do get a significant correction after Powell. But as I said, guys, for now, the bulls are still in complete control. Now, moving on to financials as well. Financials too, even though we're in a rising wedge scenario, your bulls are in full control. We are approaching overhead resistance, which is your all-time highs, roughly at around 4150 levels, right? So keep that in mind. The bulls are still in control of this daily uptrend. Your higher low is right here, 40.45. Lose that, you'll be losing a couple things. Not only will you be breaking bearish from this rising wedge that we're in right now, you'd be breaking bearish, but it could set up for the daily downtrend using this whole area as resistance. And at that point, guys, we will be in for weekly consolidation. Targets is going to be around $39 this 12 EMA. And from the top, that would represent downside on XLF financials of about 5%, which is a healthy correction for financials, even in the most bullish of markets, guys, like 2021. You can even go back prior to that. If you don't like that one, right, we can even go back to 2017. You can see even in overall bull markets, look at this clean trend right here, right? Even in notable bull markets, XLF financials can pull back 5 to 7% and just maintain an overall weekly and monthly uptrend, right? It's been seen in the past, and that's the analysis that we can do on QQQ and SPY as well, right? QQQ still has not had a 5, 6, 7% pullback. If you go back to the most bullish of markets, 2020, right? You see a number of them, right? 8% pullbacks, 9% pullbacks, right? 7% pullbacks, while in the context of an overall bull market. If you don't like that one, right? We can even go back to 2019, right? 8% pullbacks, 7% pullbacks in the context of overall bull markets, and even from 2016 through 2018, 2 years worth of a nice bull run, guys. You can see that every now and then, right, we do get these 5%, right, 5% pullbacks, sometimes a bit more, 12% there, right? But it does happen from time to time. Even if you go back all the way to 2015, guys, you can get these extended sell-offs, right? 5, 6%. So far, we have not had an extended 5, 6% pullback in a few months at this point. You can see this one right here, not even 4%. This one right here, not even 4%. And even the one we're in right now, not even 3%. We haven't had weekly consolidation, so I will be watching that very closely, not only for QQQ, but also for financials as well. Now, moving on to healthcare. Healthcare, much of the same, right? Healthcare bulls, still in control. We flushed the low today, but we didn't break below it, never closed below it. So bulls still trying to maintain a semblance of control here. Where it falls apart, if you get a close below pretty much today's low as well, right? 145.34, lose that. You'll be losing your daily uptrend. You'll be sacrificing the 12 EMA as well, which has held as beautiful support for the past 4 months now. Same thing on financials, right? 12 EMA could be potentially lost in the forthcoming week. Going to be keeping a close eye on this one, because if we do roll over on healthcare, it'll just be extended weekly consolidation. Higher lows are right here, 137.35. Even healthcare, guys, hasn't had a significant period of consolidation. Even in the most bullish markets, we usually do get some 5, 6, 7% drawdowns at any given time. And we really have not had that, guys, over the past 2 months. Even this one right here, the consolidation end of year sell-off rate was only about 2.5%, 3% at most. So could be due for some consolidation. That being said, your bulls are still in short-term control. Where I start getting a little bit wary is if we lose 144.71, these lows right here, then maybe use them, retest as resistance, and to lower lows, weekly consolidation, previous all-time highs is going to be the area of support I'm targeting, 142 for your line in the sand. Now moving on to IWM Russell. IWM Russell pulling back now. Daily downtrend started on the Russell. So Russell, first of your major indexes, that is now in a daily downtrend. Daily downtrend, what does that mean? Just means we're into weekly consolidation, as we've been potentially predicting. Obviously, that was made worse by your severe increase in yields today. Growth stocks really did not like it, and it was felt across the index, right? Big pullback, almost 2% pullback. It was over 2% at one point in the day. So daily downtrend underway, weekly pullback underway. At this point, guys, 12 EMA right in the middle of this range. Going to be looking at this range to play as current resistance. Since we broke above it, should now be acting as some form of support now that we're pulling back into it. And you guys know me, if I see 195 or better, I'm probably going to be going shopping for the Russell. But for now, just some healthy weekly consolidation started. Russell, tons of space to do it. Anything above 188 pretty much. Just looking for a weekly higher low for further trend expansion later on into 2024. And the Dow Jones holding up better than most, but still down on the day, 0.35% to the downside. Bulls still in complete control of this daily uptrend right now, using this yellow line. I've been pointing this out now, guys, for a few weeks, right? Big resistance has played as relatively big support, right? Now using it as support again and defending the 12 EMA desperately over the course of the day today. Now keep in mind these levels, guys. 38,500 is a big one. If we lose that in the following days for the Dow Jones, it will most likely be an attempt by the bears at setting a daily downtrend. And at that point, you could be due for a bit more weekly consolidation. Good thing the Dow Jones has tons of space for weekly consolidation. Anything above 37,100, since we set higher highs every single week on the Dow Jones, right? The last time that we set a lower low without putting in a high, your higher low right here, 37,150, just looking for a weekly higher low for further trend continuation. So all of these indexes, guys, do have a bit of room to pull back. And even the Dow Jones, if you take a look here, guys, at some of our weekly moves, right? Go back to some of your best bull markets and you can see every couple of months, we do get some 5, 6% consolidation periods that happened. That's 2021. Go back to 2019. You can see 6-7% here, larger one there, but I'm just going for overall bull markets and small pullbacks, right? You can see 4% here on this one, a couple little areas of correction, right? 4%. The Dow Jones has not pulled back at all, guys. The best we got in the last 4 months is not even 2% of consolidation. Even the one right now, top to bottom, not even 2% consolidation. That's just why I'm a little bit wary. Now, in terms of yields painting a somewhat bleak picture, which is why I did sell my 20-year bond plays as well. I just did not like these inflation reports over the course of the week, guys, right? Rates were on steady decline. I was expecting the inflation numbers from February to come in less hot than expected because it's a winter month. You know, usually people tend to spend less money over the course of the winter, except obviously for energy because of heating costs and stuff like that. For the most part, I expected them to be down. And now that we're coming back up, guys, bulls taking back a lot of this move could be setting up to reset the daily uptrend, and your weekly consolidation, although it was underway, the bears took back a lot on the weekly. In just a few days, guys, the bulls are now coming back. So maybe we don't yet have the confirmation that your monthly lower high is set. It was set, but now the bulls coming back with a vengeance on yields, which is just crushing your bonds right now. So I know I had previously said that yields were on the downtrend for the rest of the year, but these most recent inflation reports, guys, you know, can keep rates a little bit elevated. So do I think that we're going all the way back up here? No, but can we grind a little bit higher in an annoying fashion for the next couple of weeks, maybe the next month or two at this point, until really Jerome Powell starts physically decreasing interest rates? Absolutely we can, guys, which is why we have to be a little bit cautious. These don't move as fast as growth stocks, right? This is a relatively slow play. So I'm just looking to maybe get in a potential later date if really the market sells off and inflation fears come back and rates higher for longer fears really get accentuated in this market. We may just be due for a bit more increase in yields. At that point, I'll be trying to pick the tops at a further date when we get closer and closer to the actual first rate decrease. Maybe going to reopen this trade in April or May as we get closer, but really no rush for this trade, guys. You know, as long as we still have this uncertainty surrounding inflation and the timing and speed of rates, I really don't think that this trade needs any immediate attention. So that being said, now let's look into our major tech names. So major tech names, let's start off with Apple. So Apple up nicely 1% on the day, but still struggling, right? We're still struggling to set the daily higher low and break into a daily uptrend, right? So you can see here that the bulls are trying to recapture the hourly time frame after losing it ever so slightly. We are still in consolidation mode. The bulls still have one job to do. It is a daily downtrend. What we need to do is set a daily higher low and reverse this into a daily uptrend. Now, I was not confident in the size of Apple's bounce. The size of the bounce in relation to this down move right here is still a relatively weak bounce. That being said, Apple has performed well from weak bounces in the past. Take a look at this weak bounce right here. Roughly the same if I were to put the fib on it just at a quick eye glance. They actually came up a bit higher, about 50%. Was able to save the double bottom and rally. So this is once again going to be the case. The expected scenario in terms of your fibs is for a lower low flush because the bulls didn't bounce high enough. But the bulls still have a chance at setting a higher low and reversing this into a daily uptrend from here. That would be best case scenario. And then at that point, we're going to be looking how much of this weekly move can we recapture, but the daily uptrend is first. And so far, the bulls have not confirmed it. For that, we would need a break of Friday's high, 174.53. Then you would have daily uptrend confirmed on Apple. And then we would be targeting 180 as a area of resistance to the upside. Area of support to the downside still maintained 165. And as we trend, if we do trend lower and lower, guys, you guys know me, still going to be aggressive, playing Apple 170 down to 165. That is one company that I will still be playing when the markets will be selling off because I really like these levels. Now, in terms of AMD also selling off quite big today, 4% to the downside. And now AMD, guys, looking a little bit dicey, right? So losing the daily uptrend into daily consolidation right away. And this is big momentum to the downside, right? I showed it before previously in the video, top to bottom, talking almost 19% from their highs only about 5 days ago. Significant sell-off. That being said, even though we are currently in a little bit of a daily downtrend, meaning weekly consolidation as well. We're coming up on a big area of support, guys, and this one needs to hold. It is the previous high of this range right here, talking about 182.50. If the bears really pull us back into it, we could get stuck in this range, and at that point, guys, we'll be looking at the bottom end of the range to act as support, as it did prior in the month of February for about a month's time. It's the previous all-time highs, talking 164 down to 157, but we have to get through 182 first, so we'll see how does the price react at this level. If it blasts through it as if it's not even there, may use it as resistance, further into the daily downtrend, further into weekly consolidation, and then you look at your weekly higher lows, 161.50, guys, to really act as support. The bulls still have a decent amount of space to work with, and we are coming into this big chop zone, so it should be relatively difficult for the bears to get through that. That being said, we're going to keep a look at this. We'll keep looking at this one day at a time, guys, because even though it's a weekly uptrend, right, we could just be due for some extended semiconductor consolidation into the lower levels, which would mean a monthly consolidation wave as well. And you can see, even though there's half a month left in this, guys, by next week, there'll only be 1 week of trading left. If Jerome Powell really crushes us, very possible that this candle closes like this by the end of the month, at which point I would not be surprised if we start retesting the monthly candle in April down, just looking for a monthly higher low. Very healthy. One thing's for sure, if AMD comes down closer, 161.50, I'm buying. Now moving on to Amazon. Amazon looking okay, but still struggling with the 177.5 level, as I was telling you guys when I was going over the reasons why I was a bit nervous about the market. Look at Amazon, right? Still struggling with Amazon's financial results. I would expect this thing, even though we did have a very good boost after earnings, talking about we're still up about 12% after earnings. I was expecting them to be up considerably more and having a bit more momentum. But as you can see, Amazon really struggling with this level. That being said, we're making another attempt at breaking it right now, 178.75. We're trying to break above it. The next area of resistance, if we do break above it, is up to 188.50. Now, there's a scenario in my mind, guys, whereby if we do pull back in the markets, it's very possible that Microsoft, Apple, Google, Meta, and Amazon lead to the upside. NVIDIA may have a little bit of chill time, but for the most part, your big tech names in relation to semiconductors are not that overvalued, and Apple and Google have also been on significant dips, and Amazon is still relatively fairly valued. Could there be a flight to safety? If semiconductors fall off a cliff, financials, healthcare get a little bit of consolidation, could we end up with lots of red across the board, but then a few days here and there, you do have big tech pushing up, so meaning big tech will hold up better than most? Yes, those are the companies that I'm looking to make for them to make potentially, outsized returns in terms of not dropping as much as some other names. But for the most part, guys, could be heading into some consolidation here as well. Failure to break 178, keep a close eye, guys, 172. If we fail this level again and start trending below here, cut 172, it'll be daily downtrend resumed, it'll be weekly consolidation resumed, and then we'll look lower. 166 is your line in the sand. Lose that, you lose the weekly uptrend as well. It'll just be further weekly consolidation into monthly consolidation. Gorgeous time for Amazon to have a little bit of a monthly higher low and try to make a second attempt at this all-time high region. But as of now, nothing bad to say. The bulls are still in full control of this chart. Now moving on to Google. Google with an extremely healthy recovery, better than most, right, in the past week and a half. Just goes to show you how cheap Google was down here in the 132s, and it is still cheap at the 144s. That being said, we have now fully engulfed. We had a daily downtrend here by the bears, fully engulfed your most recent move. We are now healthily back above our previous big area of resistance, which was 141 down to 138, was previous support as well, dipped ever so slightly back into it. Now the daily bulls are back in full control, back in the driver's seat. So whenever this move tops out, look for a loss of the hourly time frame. When the move tops out, going to be looking for a daily higher low, pulling back into the 141, 138. I do believe that at that point, it'll be tremendous buy the dip opportunity for some potential continuation here. Google and Apple have sold off a considerable amount and may just get a little bit more love than other stocks if the rest of the market pulls back. So keep that in mind. Google and Apple still my favorite plays. I really have Google, Apple, and Amazon for my favorite continuation plays here for not only the short term, but really for 2024 as a whole. So keep that in mind in Google. Now moving on to Meta. Meta also still struggling with its all-time high breakout pattern, right? The line in the sand level for me, even though we're struggling right here, previous resistance, current support, the bulls are playing good defense right now. The line in the sand level, 436 for me. If we lose that over the next couple of weeks, guys, well, that will be daily downtrend confirmed really over the next week, right? Daily downtrend confirmed, and will be weekly consolidation underway. At that point, we look back down to about 456. If the sell-off gets pretty intense and we lose 456, it'll be loss of the weekly uptrend, but we won't confirm a weekly downtrend, all right? Very important to know the difference. Weekly downtrend would be this. I'm not expecting that. We may just lose the series of higher highs and higher lows, reset a bit lower, and then have to two-step change it all up again in the future. Meta has done this a couple of times in the past. One example would be right here where we had a beautiful weekly uptrend, higher low, loss of the higher low, and then they two-stepped the recovery back into a weekly uptrend. Same thing right here. Loss of the weekly higher low right here. They lose it, and then they have to two-step reset into the weekly uptrend. So that may be a situation that we're looking at for Meta. But as of now, the bulls still defending these levels nicely. They're still in full control. No red flags just yet. Those come if we break 476. Moving on to Microsoft now. Microsoft looking very good, actually breaking out of its previous all-time high area, 2.44% after being stuck here for a relative month at this point. So I want to say that I'm confident in the bulls' ability to defend this. However, if the markets pull back as a whole and Jerome Powell rug pulls us next Wednesday, very possible that Microsoft ends up back in this range. At that point, that would be a sell-off from current levels of about 6-7%, which would be a decent little sell-off for Microsoft. That being said, we're now above our resistance area, should be acting as a first test worth of support. Daily uptrend to the bulls. Any pullback looking for a higher low, anything above 402 looking for the higher low, and maybe trend continuation. That's the likely scenario, guys. If there is no sell-off into next week, most likely we'll just continue this daily uptrend, at which point your upside target is going to be 450 psychological area of resistance. To the downside, just be wary if we come back, look above, and come back down into this range, similar as what we did right here. If we have a look above, break below scenario, guys, it just means the bulls are not ready, and then we'll be looking out to the lower end of the range to protect us once again, 398. For now, though, Microsoft looking healthy. Now moving on to Netflix. Netflix, 0.58% to the upside. Really sideways consolidation, however, for the last 2 weeks of trading at this point. And I maintain, guys, that the lows of this current range right here, 593, let's call it, very crucial. Lose that, end up in a daily downtrend. You end up with weekly consolidation, but Netflix bulls, lots of space to spare. Anything above 549, just a healthy opportunity for a weekly higher low. And I've said it in the past, since we've broken out of this 575 area, I do believe that becomes the next area that is likely to be retested by the bulls in the event of any larger form sell-off. From the highs to that area, that'll be about 7-8% from current levels. Decent little area, and the 12 EMA should be curling up into that as well. That being said, as of now, the bulls still maintaining full control, obviously full control of your weekly uptrend right now, and they are still barely in control of your daily, defending this 12 EMA very, very nicely. So if we just maintain the grind upwards and there is no sell-off, the maintained targets, guys, is still the all-time highs. We are currently still struggling right now with our 615, 620 area of resistance. If we can get back above that and grind higher, you guys know next area, guys, going to be the all-time highs for resistance. Now moving on to NVIDIA. NVIDIA, right, that weekly candle. Let's see how the week tomorrow closes on NVIDIA. But usually when you get nice little doji candles like this at the top, it could signify on candle formation alone that you may just be due for a little bit of weekly retracement action. That being said, even on the daily, guys, take a look at your daily MACD might cross. Sometimes it only crosses temporarily for 3 days, but then the company had earnings, right? This one, if we roll over, keep an eye on this level right here, 844. Cut 844, you end up in a daily downtrend. That would be the first daily downtrend on NVIDIA pretty much since back here the month of December. So will be fairly notable to us. NVIDIA has not had a daily downtrend this entire time. Lose that, it's going to be daily downtrend, and you're going to end up with weekly consolidation. The first level I maintain is your pre-earnings high, about $740. And if you take a look on the weekly, guys, that would put us right about here. And the 12 EMA is coming up right there as well. And NVIDIA has usually had a good time defending this 12 EMA the entire time of the rally. So expect this level 740 to be a big one if we break down. That being said, don't get me wrong, the bulls right now are still in full control. It's just a tightening range at the top end of a move. So usually in the context of monthly bullishness, weekly bullish control as well, usually these do break bullish. But if for whatever which reason, next week, guys, we get an extended overall market sell-off, I don't believe NVIDIA will be spared. We may end up with some further consolidation here, and that is definitely going to drag SMH down further. SMH is already ahead of NVIDIA, right? Setting the daily downtrend, whereas NVIDIA has not. So it has to be notable to us, one of which is going to be lagging and leading. Just goes to see, we're going to have to see which one that is. Is semiconductors having, is NVIDIA just outperforming the index as a whole? And will there be no consolidation until we rip again? Or is NVIDIA lagging the rest of your semiconductors, some of which have already set daily downtrends? That's what I'm going to be watching over the next week. Now moving on to Tesla. Another bad day for Tesla, very unfortunate. But now, guys, we're really coming down below to our lower end of the trend line. We're literally right there, right? Almost closing below it. Very important level right now. Obviously, your bears are in full control, right? Monthly downtrend. We spent a lot of time on Tesla yesterday, so I'm not going to repeat yesterday's Tesla video. If you haven't seen it, I spent 15 minutes on Tesla going over all of these points, short-term negatives, long-term positives, and what's plaguing the stock. You can find that in yesterday's video. Spent about 15 minutes on it, so I won't be spending that time today. All that I want to say in terms of the technicals, guys, know who is in control. Long-term bears are in control of the monthly, shorter-term bears are in control of the weekly, and even on the daily, guys, daily downtrend confirmed. So the trend is your friend. Daily downside for Tesla is likely. That being said, we're approaching our last area of resistance here, guys. 152, and then after that, you guys don't want me to say the lower levels. This is pretty much down to about the 130s before the $100 level. Let's see, we're going to take this one level at a time, but your last area of support is coming up here, 152.50. That being said, if we break down below this channel, it's definitely going to have some negative momentum to Tesla. At that point, we may get very oversold on the daily, and we could just be due for a little bit of a bounce, but then we'll be monitoring what will be the size of the bounce, guys. The size of these bounces are so crucial. If it's just a tiny little bounce, then we're just gonna sell off even more. If they can get a nice bounce going, exactly like the one they did right here, almost 100% bounce, then you can see some daily trend turnaround. But until we get that daily trend turnaround, your longer term bears are unfortunately in full control. Now moving on to Palantir. Palantir also selling off on the day, 2.28% to the downside, coming dangerously close to our 23.54 lows right here. So the bears have taken back a lot of this move. It leads me to believe that any rise after this may just be for lower high into lower low. That's usually what happens when the bears take back so much of a move, right? You saw it a few times in Palantir, right? Where when the bears take back too much of a single move, you could get follow through on the downtrend, right? Too much of a single move, sometimes it takes some time. So the bears, the bulls still have a chance. It is still overall bullish in terms of daily uptrend right now. But if you get too close to this and take it out, could be setting up for the lower high, lower low. That would just mean further weekly consolidation on Palantir. Then we're going to be looking to these lows, guys, 22s. If we can come back down to 22s, I'll be very tempted to buy Palantir. But Palantir, you guys know, still just stuck in this range. Upside targets $27.50 to $28 roughly. Your longer term bulls are in full control, obviously. Monthly bulls, full control. Weekly bulls, full control, up to 22.25 to the downside. Just your daily move down, little bit much in my opinion to warrant a V-shaped recovery. But obviously if Jerome Powell is extremely bullish next week for some reason, well, then Palantir will most likely be retesting these highs around $28. I don't see any immediate urgency for this trade. I would rather wait for this one myself coming back down $22, $21, $20. I'll be more keen to play it. And now lastly, PayPal, guys. So PayPal putting in a decent day in considering that the fact that the markets were selling off almost entirely today. That being said, daily uptrend still in motion, and now we are still currently above our 2 years almost worth of downtrending channel line. So it has to be notable to us. So PayPal attempting the breakout. If I didn't have a short-term bearish view on the market, I would say that this is it, guys, and I would be going relatively heavy on PayPal for this breakout, right? One thing we need to maintain, daily uptrend needs to be maintained. So whenever we pull back from this move, I need to see them do two things. I need to see them maintain 58, which is your higher low. And I also need to see them maintain above this trend line, which is currently sitting roughly around $60. A lot of action down there, right? Previous horizontal resistance, your downtrending channel line, this line right here, and your moving averages on the daily are there as well. So I really would not like to see them lose this. If we come back, pull back onto down under this, guys, just means that we're not ready. For the most part, I don't think this will be PayPal's fault. If anything, it'll be the fault of yields going higher because of something that Jerome Powell says. in relation to inflation as well, and just the fact that the overall market would be down. That's the only case that in which I see PayPal coming back under here. So far, so good. It is looking fairly good. So that is pretty much everything that I had for you guys today. Hopefully I didn't come off as too bearish. Just keep in mind, guys, I'm still very long-term bullish on these markets. But as I've been talking about here and there for the past month and a half, it may just be the time for a little bit of a breather. And I've been going over the scenario a few times in my head. And I really believe, guys, that if we were to have one extended sell-off over the next couple of months, I do believe that March is perfectly positioned for it. Plays into our seasonality, plays into a lot of our indexes and individual names being slightly overbought, plays into our rising wedges that we showed off a bit on the channel, right? In terms of SPY, in terms of XLF, and it also plays into the fact that next Wednesday, Jerome Powell may just crush us, which he won't do in May, because then we'll be too close to the next rate decrease, which is coming in June or July, right? So if there's going to be one time where the markets maybe pull back 5, 6, 7% on the indexes, maybe a bit more, maybe a bit less on individual names, I do believe that that time would be now more than any other time. That's why I'm positioning accordingly. So hopefully that was helpful. Now let's take a very brief look into my portfolio. All right, guys, so taking a look at the portfolio, you can see that in the past 2 days, we've had quite some significant dips. So at a previous high of almost 11%, we are now only at about 5%, as a majority of some holdings in the portfolio did pull back over the course of yesterday and today's negativity, right? So we're going to take a look at exactly what happened here. Still relatively decent for the year, but I'm just in a position where I'm starting to protect some of these gains that we've had. Now, in terms of the positions, guys, you'll see that we're really light at this point, right? Not many positions left are there. So I was really serious when I said I sold a lot of holdings. We didn't sell, however, the Apple 100 shares that we got assigned at $180, but we did write some covered calls for next week just because we don't know what's going to happen. Well, I sold a little bit under my assignment price. You know, I'm taking a risk on this. I don't think Apple will close above 177.50 by next Friday. We will see, of course, but I did get about 62 cents for those. Not quite 0.5%, but I was just happy to get anything on these contracts today, just looking to cover my bets a little bit. Now, we also wrote the BABA calls for $77. Keep in mind, my average cost on BABA right now is about $77.31. Minus today's credit, guys, it's now in the 76.70 level. So not that bad at all for Alibaba. But still, as you can see, I'm not waiting for it to get back up to 82. I don't believe BABA, if the markets are red next week, I don't believe BABA is going to close much above $77. That's why I wrote those calls. If they do, I'll just roll them forward. But I'm just looking to generate as much premium as I can before a little bit of a sell-off. And Nike's as well. Nike has earnings next week, and it's a big week with Jerome Powell as well. So Nike, my assignment price, my break even on Nike pretty much, is also significantly higher than where I wrote. So keep in mind, my average cost on Nike is about $111.76. I wrote the 106. I will be very surprised if Nike closes above 106. Keep in mind, they still do have their problems in China or whatnot. But let's say they have a fantastic earnings and go up about 10%. I'll be very happy for the company. I'll try to roll calls as best I can. But I've been in this stock, guys, pretty much since the last earnings cycle in December. It's been a while, so I'm happy. My average cost now, actually with these covered calls, I didn't write them down, but if we take 177 off this, it means that my average cost, as a matter of fact, is about $110 right now. So let me just readjust that right away, 110, and I'll update the writing right here in the future. So now that our average cost is down about 110, I wrote the 106s, guys. So you can see I'm being very cautious on all of these plays. Since my overall bias is being bearish, I don't think that next week is going to be fantastic for a lot of these companies. That's why I'm writing pretty much close to break even or even below my break even, just to generate a little bit of premium. So if ever we do drop on these, at least I'm lowering my cost basis in relation to how they're trading today. Now you can see I do have one small little short swing trade open. This is a NASDAQ futures contract. It is a short contract that we took shortly prior to the close right here. So if you took a look at the level on the NASDAQ that I'm targeting, right? Break of 18,000 is going to be potentially what I personally am expecting for the foreseeable future. That's why we took the trade into the end of the day. Now, my stop loss will be all-time highs. If we break above 18,500. My stop loss is going there. At that point, my trade is invalidated and we will have to reassess potentially closer to the top of the trend line. But for now, I'm looking for the break, retest, and flush below. That's why I position short. But keep in mind, it's a very small position size, guys. I know the cost basis here says $36,000. It's just the exposure of the contract. In all reality, guys, the buying power for the position is only about $2,000 or something like this. Now, this does move relatively fast. So a 100-point move on the futures is roughly translated, guys, to a $125 move on this. So if I'm looking for roughly 400 points of stop loss to the upside, 500 points, let's call it, I'm looking at a stop loss of about $700 at the most. And my downside for profit, guys, I'm eyeing, set low 17,000s for the index. So it is roughly a 2-to-1 reward to risk trade. I'm roughly standing to make, between $1,500 and $2,000 at the most part, and only risking, $600-700. So that's going to be the expectation for that short trade. Just a little bit of a hedge for the long positions that we have. And my Canadian banking ETF pulling back from prior highs on the weekly basis. As a whole, guys, right? In terms of the week, let me just show you some of the trades because going through all of these is going to be a bit long. We'll do that tomorrow. I promise you guys I'll be doing a full rundown of my portfolio and the trades that we made this week. But here's a little bit of a snapshot. So you can see that we did earn some premium, but we did take a few losses that were open over the course of the week. Tesla, I closed 2 days ago when it was around 170 and broke the 170 support. Was not willing to take the risk on that trade. We wrote the contract earlier in the week for 80 cents. Closed it for $1.80, took a loss. Very rarely will you ever see me take losses on contracts. Usually I just don't mind being assigned. But in current market conditions, guys, I'm just protecting myself. See, Apple played out nice. We closed that today, made $63 here. Shopify earlier on the week, we closed those almost for worthless, made some money there. The Oracle swing trades, Kohl's, KSS trades, swing trades here from after earnings rather. Short puts that were pretty much worthless after earnings. Here is my Dollar Tree loss that I was showing you guys, right? I wrote the 131s, one for this Friday, March 15th, one for March 22 at the 131s. And you guys know that, as I was saying yesterday, guys, it just blasted through. And I'm actually happy I closed the loss yesterday because we'd be pretty much, a full $300-400 per contract lower. So happy I saved myself some money there. Was not happy with the company report at all. Just did not have high conviction in the company after their earnings report and their turnaround story with half of their business, really having to turn around. They're closing 1,000 stores, not looking the best for them. And we broke the massive support that I was targeting, 131. So just wanted to have nothing left to do with this stock. That's why I took some profits on that one. I mean, not profits, but I just cut the loss on this one. Went a bit greedy with 2 contracts. I was really sure of this bet here, guys, because Dollar Tree was really outperforming Dollar General. And I really believed that a large portion of their sell-off happened last year. And I believe that they were through most of their transition story. Apparently, I was wrong. So it broke this big 130 area of support to the downside. Didn't want to take the risk for further losses, so I just cut the loss right then and there. Here you can see that was a loss of almost $700, so not the best at all. We stood to make about $150 from this one and ended up losing $700, which is why I say earnings are always volatile, always a gamble. Now, thankfully, even with this one, you guys saw me lose $1,100 on Snowflake the other week as well. Thankfully, even with these few losses that we've had on earnings, we've been able to make more profit than losses over the course of the past 2 months. That being said, these are the reasons I tell you guys to stay away from earnings. If you don't cut the losses quickly and you don't understand why the position is losing, if you hold it for too long, could end up losing money. And look at Snowflake. If we didn't cut that one in the high 180s as we did, right? Or sorry, in around the high 170s, 180s, look, we'd be down another $2,000 right there. That's why you have to know when to cut the losses. And it's not that obvious if you're not that familiar with the strategy, right? Now, we also had some Dick's Sporting Goods for earnings. Those played out well, but we did lose on Lennar puts. Lennar puts, I was actually up on the morning. These contracts that I bought for 75 cents were actually trading as low. I'll show you that one trade just so you guys know that it did actually happen, right? So I did actually have the Lennars. You can see here, I closed them for $1.30 roughly. We sold them for 75 cents yesterday, and for a good part of the morning, the markets were fine, and Lennar Corporation was also fine. They opened decently and then sold off the rest of the day. I was expecting a bounce all throughout the day and just cut the contract when we ended up at the 155 level. Just cut it for a loss, guys. Just didn't want to hold the position here. So pretty much offsetting my win on Dick's Sporting Goods. Actually, this was 130. not 125, so that's actually a $55 loss, so largely offsetting our gain from Dick's Sporting Goods. And then Rivian, I had to take a little bit of a loss on Rivian as well, which we sold out of the position on Rivian too. 20+% decline in the past 5 days of trading, right? Very brutal to lose so quickly on Rivian stock here. Had the 12.5 calls for Friday, rolled them down to the 12s. The 12s got taken out pretty much today. I closed the covered calls, and I also closed the position at a net loss, about $240 loss. So I'm out of Rivian as well. EVs just getting put through the washing machine currently. So all in all, guys, that's the reason for, the roughly 5% drop in the portfolio. Everything's come down. My Canadian banking ETFs has come down. BABA shares have come down from their weekly high of $77. So that's another $300-400 there. Nike's come down from 102. That's $200 there. Apple's still relatively the same. But then we have these losses that compound, right? Giving us a total loss on the week of roughly about $363, plus the loss on Rivian that we had as well. We took profits on Bitcoin and stuff like that. But still, guys, all in all, and many, many tiny little swing trades that I had to open as well, right? You guys remember the Mellies. The Mellies I did good on, but we took a loss on Zscaler, took a loss on Merck. We had a slight gain on MCO that was offset by a slight loss on SPGI. Vici, I even opened a Vici trade yesterday because I liked the level. Closed it today because it's so interest rate sensitive. May be able to pick up Vici even lower into the lower 28 area. So I'm just looking to buy these as low as possible, guys. No real rush for these interest rate sensitive plays. Pulled the trigger a little bit early yesterday in the 29.50 range and closed it today at a loss. You guys can see that trade right here, right? Bought Vici. Where's the Vici trade? Let's find it real quick. So Vici, you can see I bought these literally yesterday for 29.56. And when I saw today's trading and yields go up, I said, you know what? There's really no urgency. I jumped the gun, got a little bit too greedy, closed them for 80 cents per share loss there. That's about another $80. So all in all these little trades, guys, they added up to really being a 5% decline in the past couple of days. Just really everything pulling back, notably here on the account, and just did not want to sacrifice the rest of the gains that we've been holding up. So now we're back to pretty much the level that we were just a few weeks ago, right? And roughly the 5-6% year-to-date gains. So now I have full buying power on the account. We'll be waiting for those dips aggressively. And trust me, I will be playing these dips aggressively when and if they do come. So hopefully that's been insightful, guys. Hopefully you appreciate the transparency. Right? And if you did, consider dropping a like on the video. Would really appreciate it. And consider subscribing to the channel as well. We do these daily market recaps every single day, Monday through Friday. And obviously the video on Sunday night, top 5 options for the week. The video for this Sunday, guys, is going to be very conservative. Just a little bit of, foreshadowing for that one. I'm going to give very conservative strike prices because I don't want anybody. I know none of this is financial advice, but I know a few of you may be following the trades here and there. So I just really want to prevent anybody from losing money if at all possible. And for that reason is why I always give super conservative strikes that I would play myself, guys. And sometimes I'm even more aggressive on the strikes that I give to the public, right? So I really don't want any of my subscribers to be taking overly aggressive or risky trades. I'd rather you guys be conservative, get those base hits, and just consistently grow the account small and small, right? So hopefully this was all educational. And obviously, if you have any questions whatsoever, please feel free to leave them down below in the comments, guys. I really appreciate all the love and support that I've been getting. All of your comments, I read them all and I answer every single one. So I really appreciate your guys' engagement with the channel. Makes it all worthwhile. We're coming up on the 1-year anniversary of the channel, almost a year that I've been doing this at this point, and I've enjoyed every single video that we've made so far. So hopefully going to be able to grow this into a larger and larger community of like-minded traders and investors who are just looking to beat the overall markets. We're not really looking for home runs much on this channel, even though you will see me play a few leap calls here and there, but that's definitely not what we're looking to for on the channel. We're just looking to consistently beat the market every year, guys. If you can consistently beat the market by 5-10% every single year using an option strategy, you're winning. Yes, there will be some down years, but usually in those circumstances, the whole market's going to be down. Usually when we either have flat, up, or even big time up years, this strategy does outperform the market, which is pretty much, 9 out of 10 market years when we don't have severe corrections, right? So hopefully you guys have appreciated the journey as well. And all that being said, I will see you in tomorrow's video, Friday after the close. So take care, happy trading, and peace.